This narrative attributes rising inflation primarily to an unusual collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in methodology and disagree in conclusions, there appears to be an emerging consensus that I believe attributes much of the rise in inflation to this collision. Overall, as the market recovers from the distortion caused by the epidemic, our efforts to moderately suppress aggregate demand, and the anchoring of expectations, these combined effects are making it increasingly clear that inflation is on a sustainable path towards our 2% target. Achieving lower inflation while maintaining a strong labor market is only possible if inflation expectations are anchored, reflecting public confidence in the central bank's ability to achieve 2% inflation over time. This confidence has been built over decades and is reinforced by our actions. Finally, I would like to emphasize that the epidemic economy has proven to be different from any previous period, and there is still much to learn from this extraordinary period. In the Statement of Long-Term Goals and Monetary Policy Strategy, the Federal Reserve commits to review our principles through a comprehensive public review every 5 years and make appropriate adjustments. As we begin this process later this year, we will remain open to criticism and new ideas while maintaining the strengths of our framework. The limits of our knowledge, made evident during the pandemic, require us to remain humble and questioning, focusing on learning from past experiences and applying them flexibly to current challenges. 2 years ago, from this forum, I spoke about the challenges that dealing with inflation might pose, such as rising unemployment and slower economic growth. Some people believe that controlling inflation must be accompanied by economic recession and long-term high unemployment. However, I made it clear that we are firmly committed to restoring price stability and will continue until our goal is achieved. The Federal Open Market Committee, FOMC, has been consistent and unwavering in fulfilling our responsibilities. Our actions demonstrate a strong commitment to restoring price stability. In 2022, we raised the policy rate by a substantial 425 basis points, followed by an additional 100 basis points increase in 2023. From July 2023, we maintain the current level of tightening policy. The summer of 2022 marks the peak of inflation. Since then, inflation has fallen by 4.5 percentage points in 2 years, while unemployment has remained low. This result is both gratifying and historically unusual. Why has inflation fallen but unemployment not risen significantly? Epidemic-related supply and demand distortions and severe shocks to energy and commodity markets are important drivers of high inflation, and their reversal is a key part of the fall in inflation. These factors took longer to fade than expected, but ultimately played an important role in the subsequent decline in inflation. Our tight monetary policy has contributed to a modest decline in aggregate demand, which, combined with improvements in aggregate supply, has reduced inflationary pressures while allowing the economy to continue growing at a healthy pace. As demand for labor has slowed, job openings have normalized relative to historically high levels of unemployment, primarily through a reduction in job openings without the onset of large and disruptive layoffs, leaving the labor market no longer subject to inflationary pressures. Source: here we should also mention the key importance of inflation expectations. The long-standing view of standard economic models is that as long as product and labor markets are balanced, inflation will return to target levels without the need for an economic slowdown, as long as inflation expectations stabilize around our target levels. This is what the models say, but the stability of long-term inflation expectations has never been tested by persistently high inflation since the 2000s. Whether the anchor of inflation will remain stable is far from certain. Concerns about a decoupling of inflation expectations have fueled the view that falling inflation requires a slowdown in the economy, particularly in the labor market. An important lesson from recent experience is that solid inflation expectations, coupled with strong central bank action, can achieve lower inflation without the need for an economic slowdown. The transitory inflation view was widely accepted at the time, with most mainstream analysts and central bankers in developed countries holding this position. It is generally believed that supply problems will soon improve and the rapid rebound in demand will slow down, prompting a shift in consumption from goods to services, thereby reducing inflationary pressures. For some time, the data seemed to support this hypothesis. Monthly data on core inflation showed a downward trend from April to September 2021, albeit slower than expected. However, by mid-year, the assumption of temporary inflation began to lose support, and our communication style adjusted accordingly. Since October, the data have clearly shown that inflation is no longer a transient phenomenon. Inflation is starting to spread from goods to services, indicating that high inflation is likely to persist. If inflation expectations are to remain stable, strong policy measures are imperative. We quickly recognized this and began adjusting policies in November, with financial conditions gradually tightening. As we phase out our asset purchase program, we initiate a rate hike in March 2022. By early 2022, the overall inflation rate has exceeded 6%, and the core inflation rate has also climbed above 5%. At the same time, new supply shocks followed. The outbreak of the Russia-Ukraine conflict caused a sharp rise in energy and commodity prices. Supply chains are improving more slowly than expected, and the shift in demand from goods to services has been prolonged by the recurrence of the epidemic in the United States. The global epidemic continues to disrupt production activities in major economies. High inflation has become a global phenomenon, reflecting the common experiences of all countries: surging demand for goods, tight supply chains, tightening labor markets, and sharp increases in commodity prices. This round of global inflation is unlike any period in the 1970s. At that time, high inflation was already well established, and we were firmly committed to avoiding a repeat of the past. By mid-2022, the labor market is highly tight, with labor demand increasing by more than 6.5 million since mid-2021. Part of the demand has been met by the return of the workforce as the pandemic eases, but labor supply remains constrained. Even in the summer of 2022, the labor force participation rate will still be lower than pre-pandemic levels. From March to the end of 2022, job vacancies were almost twice as many as the number of unemployed people, showing that the labor shortage problem is very serious. In June 2022, inflation reached a peak of 7.1%. Now let's discuss why inflation is rising and why it is falling significantly despite low unemployment. Research on these issues is still ongoing, and this is an appropriate time to explore them. Of course, it is too early to draw conclusions now, and this period will become the focus of analysis and discussion by economists for many years to come. The sudden outbreak of the coronavirus quickly brought the global economy to a standstill. This period is fraught with uncertainty and significant downside risks. In the face of crises, Americans have shown resilience and innovation as always. The government has also responded with unprecedented force, especially in the United States, where Congress quickly passed the CARES Act. At the same time, the Federal Reserve took unprecedented steps to use its power to stabilize the financial system and help avoid a recession. After a historically deep but brief recession, the economy began to recover in mid-2020. As the risk of a severe long-term recession abates and economies reopen, we also face the risk of a slow recovery like the one seen after the global financial crisis. In response to this situation, Congress passed a large number of fiscal support measures in late 2020 and early 2021. In the first half of 2021, consumer spending rebounded strongly. The ongoing impact of the pandemic has shaped the pattern of recovery. Concerns about the epidemic have suppressed consumption of in-person services, but pent-up demand, fiscal stimulus, changes in work and lifestyles, and additional savings accumulated from reduced consumption of services have combined to drive a historic surge in consumption of goods. The epidemic has also had a serious impact on the supply chain. At the beginning of the epidemic, 8 million people dropped out of the labor market. By the beginning of 2021, the size of the labor force was still 4 million smaller than before the epidemic. It will not be until mid-2023 that the size of the workforce returns to pre-pandemic trend levels. Supply chains have been thrown into disarray by reduced workforces, disruptions to international trade, and dramatic shifts in demand. This phenomenon is clearly different from the slow recovery after the global financial crisis. What follows is inflation. In 2020, inflation was below target, but in March and April 2021, inflation climbed rapidly. The initial surge in inflation focused on goods that were in short supply, such as cars, with huge price increases. My colleagues and I considered these pandemic-related factors to be short-lived and therefore judged that the sudden rise in inflation would not be sustained and would not need to be addressed by monetary policy. In short, we believed that inflation was transitory. Conventional wisdom has long been that central banks can ignore short-term increases in inflation as long as inflation expectations remain stable. When discussing employment issues, looking back on the years before the pandemic, we have witnessed the many benefits that a strong labor market has brought to society. Low unemployment, high labor force participation rates, a narrowing of the racial employment gap, and low and stable employment rates. In an inflationary environment, healthy growth in real wages, especially low-income groups, will benefit the most. However, today's labor market has cooled significantly and is no longer as overheated as it was in the past. The unemployment rate has been rising since it began more than a year ago and now stands at 4.3%. While this number is still historically low, it is up nearly a percentage point from the beginning of 2023, with most of the increase occurring in the past 6 months. So far, the rise in unemployment has not been caused by the massive layoffs brought about by the recession, but has been largely attributed to a sharp increase in the labor supply and a slowdown in hiring. Even so, the cooling of the labor market is still apparent. While job growth remains solid, the pace has slowed. Job vacancies have declined, and the ratio of vacancies to unemployment has returned to pre-pandemic levels. Hiring and resignation rates are below 2018 and 2019 levels, and nominal wage growth has slowed. Overall, the current labor market is much looser than in 2019, before the epidemic, when the inflation rate was below 2%. Therefore, the labor market is unlikely to be a source of inflationary pressures in the short term. We do not seek or expect further labor market cooling. Overall, the economy is still growing at a solid pace, but inflation and employment data suggest things are changing. Upward risks to inflation have weakened, while downside risks to the labor market have increased. As we noted in our last FOMC statement, we closely monitor the risks associated with achieving our dual mandate. Currently, it is time to adjust policies. The direction ahead is clear, and the timing and speed of rate cuts will depend on incoming data, the changing economic outlook, and the balance of risks. We will do everything we can to support a strong labor market while moving steadily towards price stability. With appropriate easing of policy restrictions, there is reason to believe the economy can return inflation to 2% while maintaining a strong labor market. Current policy rates provide ample room to address a variety of risks, including the possibility of further deterioration in the labor market. It's time to adjust our policies. Full text of Powell's Jackson Hole speech. On Friday, Federal Reserve Chairman Jerome Powell delivered an important speech at the annual Jackson Hole Conference, which attracted widespread attention from global markets. He said that the Federal Reserve has officially started its interest rate cutting cycle. The following is the main content of the speech. Today, more than 4 years after the outbreak of the new coronavirus, the worst economic distortions caused by the epidemic are gradually receding. The inflation rate has dropped significantly, labor market tensions have eased, and the current overall financial market conditions are even looser than before the epidemic. Supply chain problems have been basically resolved, and the risks of facing dual missions have also changed. Our goal is to restore price stability while maintaining a strong labor market and avoiding the high unemployment rates seen in the past when inflation expectations were unstable. We have made significant progress in this process. Although the final goal has not yet been achieved, the results have begun to show results. Today, I will focus on discussing the current economic situation and the future direction of monetary policy. At the same time, I will review the economic changes since the outbreak of the epidemic and conduct an in-depth analysis of why inflation has reached a high level not seen in decades in the context of low unemployment, and why inflation fell sharply while maintaining a low unemployment rate. Short-term policy outlook. Let's start with current economic conditions and short-term policy outlook. Over the past 3 years, inflation has been well above the Fed's 2% target and the labor market is extremely tight. The Federal Open Market Committee, FOMC, has made curbing inflation its main task, which is completely necessary. Before this, most Americans had never experienced the pain of long periods of high inflation. High inflation imposes a huge economic burden, especially on those who struggle to cope with the rising costs of daily necessities, such as food, housing, and transportation. Inflation also exacerbated feelings of social injustice that have yet to fully dissipate. The Fed's tightening monetary policy has effectively alleviated the imbalance between supply and demand, reduced inflationary pressure, and ensured the stability of inflation expectations. Today, inflation is close to target, with prices rising 2.5% over the past 12 months. Although inflation slowed earlier this year, recent developments suggest we are making steady progress toward our 2% goal. I am increasingly confident that inflation will return to the 2% target.